Arista Networks is one of the most impressive companies in the entire world. We can see over the last 5 years, it's up 770%. That is a crazy good performance, but it gets better if you zoom out. Since early 2015, the stock price was somewhere in the mid fours. Not the mid 40s, the mid fours. That is crazy, crazy good. And it's not just a stock that's gone up just off of hype. This is a company that has grown profit and revenue many, many multiples over the last decade and even 5 years. And the PE ratio is in the mid 50s, but this is a company that's grown so much. I don't even think that's that expensive. And they're in an industry, the data center specific field, where multi-trillion-dollar companies are pouring more and more money into it every single year, and it doesn't show any signs of stopping. So ANET, whether you have a deep understanding of the company or you've never heard of them before clicking on this video, I hope to dive into the numbers and future surrounding this company to hopefully give you a clear understanding of where this company sits and maybe if this is a good investment for you or not. Of course, when investing in a company, it's important to actually understand what they do and understand it at least to a degree where you could explain it to someone. ANET, it's really easy to understand it at a basic level. They just help data centers run. That's what they do. You need internet to all the machines, you need it fast, you need it organized, and that's what ANET helps do. That's the simplest way to explain. Going into a bit more detail, of course, you can read all this, but they have specific operating systems, right? Extensible operating systems and other things that just really help data centers run more smoothly. It is a complicated process, networking. I'm not a networking guy. I work in a pseudo data center. Not going to go too much detail into it. I'm not the networking guy, and the networking guy sometimes has a really easy job, sometimes has a very nightmare job. So when things go wrong, you need to be there and you need to be there quick. So networking is very, very important. And with all the money pouring into data centers and AI data centers and cloud data centers, you can see it. Look at the money being poured in by Microsoft, by Apple, by Google, Meta. It's just, there's so much money being thrown towards it, and other companies not as large too. There's just so much money going into it. Of course, ANET is benefiting, but they're also doing it in a way, and they're doing it very successfully. They've been a company that's grown incredibly, incredibly fast. But we're going to dive into the numbers a bit more on just how much they've grown, and it really is shocking. In my opinion, Arista Network is the growth stock label personified. When people ask what a growth stock is, this is probably the first stock I think of. And you may disagree. You may say, okay, I picture something more in the 30 to 45 PE range. Somewhere a PE of 50 or 55 is a bit extreme, and that's what we're sitting at for ANET. We're at 55 PE. However, I would disagree that this is an extreme example. Well, it is slightly extreme. It is extreme when you look at how much they've grown. I mean, we're going to look at this more in depth later. They have no debt. And this is a company that in 2015 was doing about 1.1 billion in revenue. In 2023, which by the way, 2024 is better significantly, they did 2.2 billion in profit. You heard that right. Their profit is double what their revenue was 9 years ago. Technically 10 years ago, but the full year. So by the end of 2015, 9 years ago. That does not happen. That just does not happen. And we're going to look at some of this stuff later, but even in the last 4 years, this is a company that's grown incredibly fast, incredibly well. And by the way, we're talking about this, they're in a good industry. They are. This isn't like selling oil and they just had a boom year or whatever, some random commodity. This is real, tangible, and it's continuing to grow, right? This next year, we're going to do about $7 billion in revenue for 2024. 2015, like I said, we did 1.1 billion in revenue. That's 8xing revenue with a good, solid profit margin. No debt. You don't see this. You don't see this in companies every day. Yeah, there's the NVIDIAs of the world. This is in par with NVIDIA. Over the last decade, it roughly has performed in that range. This is a company that also factor in, it's not like they're worth 3 trillion. Right? I don't always look at market cap, 150 billion. There's room. There's theoretically plenty of room. It's just crazy. It's just crazy when you see a stock doing this well. And like I said, 59 or 60%, let's round up, 0.5%, 60% growth from 2021 to 2022, 51% growth from 2022 to 2023, 26% growth from 23 to 24. Obviously, we don't have that last quarter in, but we have most of it. So unless they just absolutely miss, which is very unlikely, it's just phenomenal. And it's not just earnings per share. It's not like they're just abusing some business that's short term. Like, look at this revenue growth: 48%, 33%, 20%. And you could say, yes, 55 is a high PE, so you would have to grow at these rates. But if you do grow at these rates, let's look a decade in the future. Say your earnings per share revenue is exactly 20% year over year. Compound that every year for a decade. Do the market. The S&P 500 is probably going to perform somewhere around 11%. You may say 12, take 3 off for inflation, whatever. On average, it's 10. So do that. Do 10, 11, do even 12. Compound that year after year with a 30 PE versus a 55 PE and see where you end up. Now, of course, there's no guarantee this company keeps growing at 20% year over year. You'd expect it not to forever. However, the chance that it keeps growing like this, anywhere near the rate, like I said, do that 20% year over year versus the 10, 12 with 30 PE with 55 PE. See which one comes out on top after a decade. I think I know which one is. So, yes, do you want every single stock in your portfolio to be 55 PE and higher? Probably not. Not unless you're 20 and you're diversifying against every growth. But at that point, just buy a growth ETF. But if you want to take a shot, you want to invest some money into a company that has done incredibly well in a good industry, there's nothing wrong with buying a PE at this level, but you have to understand the risk. Understand the risk, which is if this company starts growing like a normal company, this PE will probably deflate down to 30. But if you factor that in, I think it's fine. I think this is one of the better growth stocks you can find. Like I said, done phenomenal over the last decade, done phenomenal over the short term, projected to do good next year. It's hard to find stocks that line up with all this. So yes, PE of 55 is high. However, once you factor in everything around it, it's really not surprising. It's not surprising at all. Looking at the balance sheet, the first thing that sticks out to me, no debt. None at all. They haven't had any debt, haven't borrowed anything, haven't paid it off. Real simple. Not going to spend too much time on that, but usually that's what I like to look at first. That tells you the path the company's taking. Are they risky? Are they safe? No debt. That's pretty simple. Liability has increased. Total current liabilities has increased fairly dramatically since 2019, basically 3xing. It's not a large portion compared to assets. I really wouldn't be too worried about this at all. You're seeing an increase everywhere else. It's just there's nothing here that's really sticking out to me, for better or for worse. Now, this is where things get really interesting. Right, from 2019 to 2020, you saw a little bit of decrease in income. But since 2020, you're over 3xing. And we're having another 20% year this year, 25% for earnings per share. That is awesome. That is phenomenal. You haven't quite 3x'd on revenue, but that just shows you're getting a higher profit margin. This is great. You don't see companies do this nearly ever. It's a crazy run. It's a phenomenal run. You're super excited. I talked about this. We're going to go over future or the historical earnings per share, historical PE, to just kind of compare. And yeah, we haven't seen an increase, but you don't see stuff like this super often. This is great. There's nothing here that is concerning whatsoever. It looks phenomenal, and most companies will never, ever see something like this unless they just fell off a cliff. You'll never see, we hit a record revenue at 90 to 925 million. And then 2 years later, they're at 2.2 billion in profit. It's just, you do not see this. Great job by the company, clearly. Normally, I like to provide a visual breakdown of the last quarter of a company. Couldn't really find a good one for ANET, so we're just going to look at one of the earnings reports. So last quarter, see 20% year over year. We saw that kind of earlier. A couple of things that stick out here. I'm not going to dive into every single thing. Cash, lots of cash. It's nice. It's awesome. Look at R&D spending. 175 million, 9.8% of revenue. That's not that much. That's what you would expect. I actually wouldn't mind it even being higher. They don't need to, right? That's fine. But I would not mind that being higher. I wouldn't mind that being higher at all because I want my company to keep growing. I want that revenue to grow. Now, maybe they're already at their ceiling. I mean, when you're growing this fast, it's really not too surprising. Another thing that sticks out, stock repurchase. That's nice. We like to see that. Maybe even a little bit more. They have a lot of cash. Should start throwing it around, in my opinion. But like I said, it's hard to complain about a company that's growing at the rate they are. Right? Look at that operating income, 50% profit margin. Super nice. Net income. This is a company that has a high profit margin. It's not too surprising. What generally the cloud stuff, cloud area, just generally it has higher profit margins throughout. It has a high margin for those selling the chips, has a high margin for those providing software and help, and it has a high profit margin at the end of it with like an Amazon or the Meta. You see an Apple, a Microsoft. Those are the higher tier, generally the higher profit margin, unless you're doing like a services. They're the higher profit margin elements of the business. It just is. So it's a higher profit margin throughout the chain. There's a reason people are throwing so much money into it. Guidance, another record. I mean, we can kind of see some of that, right? We're up there. Revenue for this quarter, 1.8. We're guiding somewhere between 1.8.5 and 1.9. Generally, they actually beat that. Let's just take a quick peek. So I'm not lying to you guys. Yeah, last 4 quarters they beat, not dramatically, but they beat. They really have. Actually, that is pretty decent. It's only a couple cents, but it's not much. So they usually beat 10%ish, which is pretty dramatic. And then 2025 revenue growth projection, 15 to 17. That's like not bad. That's really not bad. Especially if you consider they beat. If you consider they beat, that's probably like 19, 18. If we're being conservative, we say 15. Wow, this company's growing 15% rate now. If it only grows at a 15% rate, is the 55 PE a little high? Yes. But who's to say the year after that isn't 30? I'm not saying it's going to be. But there's a company you're going to bet on for growth. It's one of the better ones to do it. It really is. So there's nothing here that sticks out as bad. It's great profit margin, right? Not a lot of R&D, not a lot of operating expenses. It really looks pretty phenomenal. It's if you're drawing a company that's realistic, that's growing, and had a kind of a back down to earth year, it would look like this. It really would. Of course, every company has unique risks and advantages. It's important to discuss them to actually understand, okay, this is the risk I'm taking when investing in this company specifically. For ANET, I've talked about it throughout this video. But in my opinion, the riskiest thing, and it's not even close, is just the PE ratio. Because if this company starts growing like a normal company, you're going to lose that premium that you're buying in with the PE premium. It's just reality. You're buying in a premium because they are growing so fast. That's, in my opinion, the biggest risk, because we can dive into the business itself. Is there risk? Yes, there is. There's one risk. People stop investing in data centers. I laugh at that notion. Not that it's impossible, but it's very unlikely. And you could make that argument about any sort of business if that's the case. Well, what if this quantum computing comes around? Well, then all these other companies are sort of defunct. You could make that case for any industry. Well, if people stop buying this, why? They're making so much money investing in it. Well, maybe this other thing will come along. I just think that's a little bit silly. Not that it couldn't happen, but and probably a lot of other companies you're betting on that as well, even if you don't know it. So I don't think the industry they're in is going to have any money not pouring into it anytime soon. So that's not what I'm worried about. There's high profit margins, so you're not really worried about that. Probably another worry you would have is competition. I don't think there's a whole lot of competition. You can see that by the high profit margin. You can see that by the amount of growth. Clearly, they're needed. And you can also see it by when you have stuff like operating systems, extensible operating systems. Operating systems have really high barrier to entry. They're complicated, they're confusing, and if you get a lot of people using them, people really don't want to switch. That's why, even though Mac has been fairly successful, still vast majority of people use Windows. Vast majority of people do not use Mac and Linux. And now, clearly, I'm making the case that there can be competition. Certainly, this is a company that, although it's a couple $100 billion, we do have to factor in not even a couple $100 billion, 1.5 or $150 billion, right? You do have to factor in that they aren't at the point where they're ginormous, right? If they're at 30 PE, they would probably be just about 100 billion, and there's still room for competition to creep in. Now, is it likely? No, but there certainly can be. That could cut into margin. So those are the other two disadvantages. Advantages, I'm going to do the complete opposite of one of the risks. I think this is an industry that a boatload of money is going to continue to pour in. It already is. You can see companies like Meta. Meta is pouring nearly 25% of their, they're just pouring a bunch of money. Everyone's pouring a bunch of money. I mean, you can see it by the success of NVIDIA and AMD. I mean, AMD, if you look at beyond the stock price, you look at how much their data center segment is growing. In 2019, they were doing $800 million in revenue in that segment. They're doing over $3 billion now. You're seeing similar amounts of growth year over year with that. Now, there are other stuff doing. This isn't an AMD video, but the point is, a lot of money is going to pour into this specific field, and they are well positioned for it. I believe that. You can see economic moat wide. This is true. That's the number one thing. Important industry, success and growth, and wide economic moat. Harder to get much better than that, in my opinion. So that's all the advantages and risks I'm going to cover. If you've watched my content for a while, you know I do not like predicting share price. I don't like doing it. I'm uncomfortable by it. I think that's not often how stocks work, because oftentimes there's too many variables. Even when companies are doing well, stock price can be down. So many complicated factors. However, I think it's important in these videos to kind of lay out what I'm thinking about the future of a company so you guys can get a clear picture of what I'm actually thinking. Now, obviously, I've said a lot of good things about ANET. I think this is one of the harder companies to predict the future of, in my opinion. How's it going to do? I think when you have growth like this and a PE ratio like this, you're just increasing the scope of it going really good or really bad. There's a high floor and a high ceiling to this specific asset. I believe so. I think you could look back in 10 years and be like, wow, this was the best buy I ever made. I don't know, 10 years a long time, but even something like 5 years, there could be a recession in 4 years, and the 5th year really doesn't look that good. In 10 years, you'd be saying, wow, I really underperformed here. And I only think that would be if this starts growing like a normal company. I don't see it being terrible. But you could, if you grew like 10% at this 55 PE and compressed down to a 30 PE, you would have been much better just buying the S&P 500. Now, I think this is going to be a company in terms of earnings per share growth. It's going to do very, very, very well. Now, the PE, this is going to be probably the key. Do we see this hit closer to 80 PE? Good. Do we see it go closer to 40 and kind of stay there? If that is, you're losing a lot just off the top on the PE ratio. But hopefully the earnings makes up for that. I do not know how to project this. However, what I am going to say, and this is a bit of a cop-out, I do think the earnings per share, the profit growth is going to outpace the S&P 500 over, let's say, a 5 to 7 year period. That's what I think it's going to do. Now, just because it falls in that range doesn't mean it's a buy. But I think if you are a person who's well diversified, who believes in the data center industry, you want more exposure to it, and you don't mind a growth stock or two, and you don't put a crazy amount of your wealth into it, I think this is a perfectly fine buy. Just understand the risk you are taking. If you understand the risk you're taking and you get burned, you at least know, okay, I did that and I understood that risk. I just lost this time. Or maybe I don't want to do that again. Or maybe I should have bought this, just understand it. And then you should be completely fine. I have no worries about this stock in particular. I kind of have a good feeling about it, and I almost never have good feelings about this PE ratio, no matter how fast you're growing. This is one of the better growth stocks above 50 PE you will find because of the moat, because of the growth they've had, and because of the industry they're in. Outside of PE and stock growth, those are important things people sometimes discount. Anyways, I appreciate all of you for watching. If you enjoyed and made it this far, I know you enjoyed at least a little bit. Subscribe if you want to see similar content. I'd also appreciate if you left a like, but if you made it this far in the video, you already gave me quite a bit of watch time, so I appreciate you for that. So anyways, I'll catch you next time. Thanks for watching.